Taxation of trusts, an example and the solution. So when you start a question, it's always important to look at the required first to see exactly what is asked of you and what to look for in the question's information that is relevant in doing this answer. So we have to calculate the taxable income for the year of assessment ended 28 February 2023. So it's only the taxable income, not a tax calculation as well of normal tax or net normal tax. So don't waste time unnecessarily then. So we have to do it for B.R. Camp, Bess Camp, Peter Camp, Sue Camp, John Camp, and the trust. And it says, please indicate inclusions and exemptions from gross income separately. Let's carry on with the solution. So the information is B.R. Camp is 55 years old, founded a trust on 1 March 2022 with the following stipulation in the trust deed. The trust is managed in the Republic. The beneficiaries are his wife, Sarah Camp, 50 years old, to whom he's married out of community of property, and their children. Peter Camp is 27 years old, working in the USA and not a resident of the Republic. So immediately you must know it's a non-resident, and section 7(8) applies here. Sue Camp is 23 years old and working in Johannesburg, and she's married in community of property, so she is married in community of property, so whatever investment income she earns will be divided into two because of the marriage in community of property. And then John Camp is 15 years old and still in high school, so you must immediately know this is a minor, and section 7(3) can apply. So we look at the payouts. An annuity of 3,000 Rand was paid annually to each beneficiary, and that was paid from the rental income. And then there were also distributions of additional income at the discretion of the trustees, who are Mr. B.R. Camp, his attorney, and his auditor. The Camp Trust incurred the following transactions during the year of assessment. Mr. B.R. Camp transferred the following assets to the trust: a block of flats to the value of 1 million Rand, and the rental income of the flats amounted to 96,000 Rand for the year of assessment ending 28 February 2023, and the costs, charges for the leasing agent and maintenance amounted to 16,000 Rand, and the annuity is paid from this rental income, remember the 3,000 Rand per annum. And B.R. Camp sold the block of flats on 1 March 2022 for 1 million Rand to the trust by means of a loan bearing interest at 5% per annum. And we assume SARS regards the 5% as a reasonable interest rate. And B.R. Camp purchased the building in 1991 for 470,000 Rand, and it was valued at 650,000 Rand on 1 October 2001. And B.R. Camp will be allowed to use the market value as the valuation date value for capital gains tax purposes. Then B.R. Camp's mother, Mrs. Bess Camp, she's 70 years old, transferred an investment to the trust. She donated a fixed deposit of 8 million Rand in a local bank on 1st of January 2023. The trust earned 110,000 Rand of interest on this deposit. 40,000 Rand of the interest income was divided equally between the beneficiaries at the discretion of the trustee or trustees, and the only other expenditure in the trust was the trustees' fees of 14,000 Rand for the year, of which B.R. Camp received 12,000 Rand. Peter and John each has a vested right of 25% of the trust income, but Sarah and Sue's portions would accrue to the rest of the beneficiaries with their death. So they don't have vested rights at death, only Peter and John has. And the trust must remain in existence until John turns 30. So there's a condition. So section 7.5 could apply. Then the trust assets and any accrued income must be divided equally between the surviving beneficiaries. Peter and John's portion accrued to their estates should they die before this time. B.R. Camp earns a salary of 20,000 Rand per month, while Bess Camp, his mother, receives a pension of 6,000 Rand per month. You can accept that they have no other income or expenditure. Now we look at the apportionment calculations for the period 1 March 22 to 28 February 2023, and it's divided up into the flat rentals, the fixed deposit interest, and the total. So the income rental was 96,000, interest 110,000, total 206,000. The costs, that was the agent commission and repairs, 16,000 for the rental. Interest, 5% interest on the R1 million loan of B.R. Camp is 50,000 for the year. That comes from the rental. And we left with 30,000, 110,000 and 140,000. And the trustees' fees, the rental was 3,000 and 11,000 for the interest, in total 14,000, which is deducted. Then we left with 27,000, 99,000 and 126,000. And the annuities that were paid during the year to each beneficiary, Sarah, Peter, Sue and John, 3,000 Rand each, was paid from the rental, and that leaves 15,000, 99,000 and 114,000. Then there were discretionary payments to Sarah, Peter and Sue and John. That was paid from the interest portion, so that was 10,000 Rand each. Then we left with 15,000, 59,000 and 74,000. Then what was vested in Peter and John is 25% of what's left of the income. So 25% of the interest of 15,000 gives 3,750 Rand to each of them, and of the 59,000 interest gives them 14,750 Rand each. And then we are left with the retained income in the trust of rent 7,500 and the interest 29,500, in total 37,000 Rand. So the solution, first for B.R. Camp, 55 years old. He earned a salary of 20,000 per month for 12 months. That gives you 240,000 Rand. The interest he earned on the loan to the trust, 5% of the R1 million, less the 23,800 Rand exemption, gives taxable interest of 26,200. The trustees' fees he received 12,000. It was given in the question. And the capital gains tax from selling the rental property to the trust, sold it for 1 million Rand, and the valuation date value or the base cost is 650,000 Rand. Deduct that, less the annual exclusion of 40,000 Rand, and that answer multiplied by the 40% inclusion rate gives the taxable capital gain of 124,000 Rand. So his taxable income in total is 402,200 Rand. So now, important to note is that B.R. Camp sold the block of flats to the trust and charges an acceptable interest rate. So this Section 7 deemed provisions do not apply because this was not a donation. We'll look at Best Camp. So she receives a pension of 6,000 Rand per month. So times 12 gives us 72,000 Rand. The fixed deposit, there is no capital gains tax consequences on a fixed deposit. It's cash. Discretionary payment to Peter, Section 7.8 applies because he's a non-resident. So the interest is taxed in Bess's hands, 10,000 Rand, and the vested because she made a donation. So Section 7 applies to her. And the vested payments to Peter, Section 7.8 again, the interest that was vested in Peter, 14,750 Rand, because he's a non-resident, and retained income in the trust that remained, Section 7.5 applies. There is a condition in the trust, so that 29,500 Rand is taxed in Bess's hands, and the interest exemption for people 65 years and older is 34,500 Rand, so we deduct that. So we left with taxable income of 91,250. And just to note as well, Best Camp donated the fixed deposit. So Section 7 deeming provisions apply. So 7.8 and 7.5 applies to her, but Section 7.3 that relates to minor children does not apply to her because John is not her minor child, he's her grandchild. So Section 7.3 cannot apply. Now we look at Peter Camp, the non-resident. He will be taxed on Republic source income. So the annuity that was received from the rental income, that 3,000 Rand, will be taxed in his hands. Section 7.8 does not apply to B.R. Camp because he did not make the donation. Then the interest received, that 10,000 Rand, that was taxed in Bess's hands, and the vested right of 14,750 Rand interest was also taxed in Bess's hands, and the rental income from B.R. Camp does not apply because he did not donate the flats, so that will be taxed in Peter's hands, 3,750 Rand. So his taxable income is then 6,750 Rand. Now Sue Camp, she's married in community of property. So the annuity, the rental income she received, 50% of that will be taxed in her hands because she's married in community of property, 1,500 Rand. The interest that was received, 50% of the 10,000 Rand is taxed in her hands, 5,000 Rand, but then she gets an interest exemption of 23,800 Rand, but it's limited to the interest of 5,000 Rand. So that's deducted, then she's got a taxable income of 1,500 Rand. So now we look at John Camp, the minor of 15 years old, still going to school. So he receives an annuity from the rental income of 3,000 Rand. So Section 7.3 does not apply, like I said, because B.R. Camp did not donate the block of flats to the trust, but sold it to the flats and earned a reasonable interest rate on the loan. So the discretionary payments, the interest that was received, the 10,000 Rand, is taxed in his hands, not in Bess's. Section 7.3 does also not apply to her because she's not his mother, but his grandmother. And then the vested right, the interest received, 14,750, will likewise be taxed in his own hands, and the rental income that vested in him, it's not a donation, the flat wasn't donated, 3,750 will then be taxed in his hands, and then he gets the interest exemption of 23,800 Rand, which is deducted, and he's got a taxable income of 7,700 Rand. Now the taxable income of the trust. So what remained in the trust was rental income of 7,500 Rand after all the distributions were made to the beneficiaries, and there was interest that remained of 29,500 Rand. So the rental income will be taxed in the trust because Section 7.5 relating to a condition in the trust deed does not apply to B.R. Camp because he sold the block of flats to the trust on loan account, and the interest that was paid to him on the loan account was deemed fair by SARS, and so it is not a donation, so the deeming provisions of Section 7 cannot apply to him. And the interest that was taxed in Bess Camp's hands, the 29,500 Rand, because the condition applies to her. The Section 7.5 applies because she donated the deposit to the trust. So the taxable income of the trust then is only 7,500 Rand.